Okay, hello everybody and welcome to OpenMike, still on the open road, joining you today from Darien, Connecticut. Please forgive my appearance, a little bit of traffic today means I didn't have time to freshen up. Since US presidential elections occur every 4 years, there isn't much data to analyze. Nevertheless, we currently are in an election year, exactly halfway through it as of today. The S&P 500 has yielded an average return of 7.9% per year since 1928. That was the year that Herbert Hoover was elected. However, focusing only on presidential election years, the average return slightly drops to 7.5%. Interestingly, if a sitting president is running for re-election, the average return increases to 9.3%. And it further improves to 9.9% if the incumbent wins and stands at 7.9% when the incumbent loses, as seen with Hoover, Carter, George Herbert Walker Bush, and Trump. LBJ's election in 1964, a year when the S&P returned 13%, might suggest that JFK would have won that election, and had that been the case, then the incumbent re-election statistics would actually have improved somewhat even from those numbers. LBJ's presidency was also notable because he chose not to seek re-election in 1968, a year with a very modest S&P return below average of 7.7%. So why does the market tend to outperform when incumbents are re-elected? It could be due to the electorate's confidence in the economy or their belief in the incumbent's capability to handle the nation's challenges, as was likely the case with FDR. As of Friday's close, the S&P 500's total return for this year stands at approximately 15.3%. And actually, it was up slightly today from those numbers, which is better than average and surpasses the returns typically seen when an incumbent wins or loses. The economy appears stable, low unemployment, modest growth. The S&P earnings for June actually were up about 6.4% versus June a year ago. So things are generally looking pretty good. The question we have to ask, though, is will this strong performance continue through the end of the year? Regardless of political preferences, this presidential election cycle is atypical. Biden's fitness for office is being questioned even by some staunch supporters, raising the possibility of his withdrawal. Meanwhile, Trump faces ongoing legal issues. We may be in precarious territory when combining election uncertainty with current market valuations. The S&P 500 is just off its mid-June all-time highs with price-to-sales ratios of about 3 times and price-to-forward earnings of just under 23 times, both above average. A market correction could be more likely now than it seemed 2 weeks ago, as suggested by the current pricing of S&P options. On December 31st, 2024 expiration options, the 5350 puts showed higher implied volatility than they did 2 weeks prior, and the 5550 calls had a lower implied volatility. So one way to interpret this is that the market is reducing the probability that the market continues to rise from here, and it is increasing its estimation of the probability of a market decline. So the question then is, what should investors do if you happen to agree with these basically concerns that I have and concerns that the options market is expressing, at least based on the changes in implied volatility over the course of the last 2 weeks? So betting against high-performing stocks like NVIDIA, which are really experiencing just unique growth and are less influenced by political issues, is probably not the right course. And instead, hedging the S&P itself could be the most prudent approach. Options like the SPY August 535 puts are currently priced around $5.50, which is roughly 1% of SPY's underlying price. And I was also looking at the SPX 5350 puts. So those are approximately corresponding to the 535s, and those are priced at around $50, so a little less than 1%. The delta of the SPY puts is slightly greater. Remember that SPX, the index, does not pay any dividends, so there's some dividend impacts, things like that, that are going to impact the delta of these strikes and how close they are to the money. And by the way, I'm looking at the August monthly options, so the ones that expire at the end of the month. The reason for that is that the Democratic National Convention is slated to take place in the second half of August. So the idea here is that one could risk give or take 1% of one's portfolio. And another quick point I would make is remember that the multiplier for each of these contracts is 100. So if you're thinking about notionally give or take how much each contract insures, you could take either the strike or the at-the-money price for the underlying and multiply that by 100. So in the case of SPX right now, which closed 54.75, each contract represents notionally almost $550,000. And for SPY, it's going to be 1/10 of that. Bear in mind that this is a place where delta is going to come into play a bit. So if you buy, these puts are both approximately 30 delta. So you can imagine that if the S&P declines by 1%, in this case, that would be, about 55 points, 55 S&P points. Then that $50 put is going to appreciate by approximately 30% of that number, $15. So it'd go from 50 to 65. And your profit on that would be the difference in price times the 100 multiplier, or about $1,500. Now, because these options have gamma, their delta will increase if the market declines precipitously, and the delta of those options will decrease as the market rises. Your long convexity here. And now, one of the things I highlighted was the fact that S&P options, the out-of-the-money puts have gone up, out-of-the-money calls have gone down. That increased skew would suggest that put spreads might be an attractive way to play this because they're going to be less expensive, right? So if at-the-money vol stays basically the same, out-of-the-money put vol goes up, then you're either going to pay less for a put spread of a given distance, or you could get slightly wider strikes, perhaps spending the same amount. So why am I not doing that here? Well, I don't think 1% of one's portfolio at this point is a great deal. It's been a good year so far. I think if there is some uncertainty, the next couple of months would quite reasonably be expected to incorporate some of that because of the Democratic National Convention. And by the way, remember when I often talk about things like not doing buy rights or covered calls going into catalysts, known catalysts such as earnings, here we have a known catalyst. And I don't think that this would normally be something that you would anticipate would contribute a great deal of volatility to the market. If you had a sitting president running for re-election, even with the economic data that we have right now, modest growth, coming off obviously some pretty high inflation, that's got people quite upset, rightly so. But I think that it would not normally be cause for much concern going into a party's convention. But net of the debate, and I don't really, this is not a referendum on anybody's political point of view. I have mine. I'm sure each of you has yours. But I don't think that there's any way to look at the debate performance and assume that Biden's nomination is 100% secure. And even if it was, I think we have some legitimate reason to be concerned about his fitness to serve. And regardless of whether you happen to agree with that or not, the fact that foreign leaders, domestic politicians, so folks in Congress, folks in the media, there's a crisis of confidence. We don't have a parliamentary process here, so there is no confidence vote. But the fact is, many have lost confidence in the president's fitness for office. And that creates a great deal of uncertainty. Now, I will offer the following, which is that, and this was reported by Business Insider earlier today, that somebody from the Biden campaign said that if he were to withdraw, his war chest, his campaign war chest, would be transferred to Kamala Harris. And with respect to market volatility, one might assume that that would contribute less to it because Kamala is already in the administration. She is, after all, second in line to the president if he should step down or otherwise become incapacitated and so on. So if he were to withdraw and she took his place, that would be the natural chain. That would be the natural progression. Again, that's not a recommendation. I'm not suggesting that's what I would favor. But I would suggest that it's probably less likely to contribute meaningfully to market volatility. The market doesn't like uncertainty. It likes to have some measure of predictability from leadership with respect to policy. And one might assume that this would create at least that basic level of continuity in terms of the assumptions that folks might have. So just to reiterate, I think between now and the end of August, with this uncertainty, there is the possibility that we could have more volatility than we normally would experience at a time like this. Makes sense. We have more uncertainty. And the market generally doesn't like uncertainty. The market is up 15.5-ish% year to date. That is well above average for any year. It is well above average for an election year. It is well above average for an incumbent winning. And right now, that not that that's the only driver, but that's a legitimate concern. 6.4% year-on-year S&P earnings growth for the month of June. That is, within spitting distance, we can say of the average. As I've pointed out frequently, I think we kind of expect S&P 500 earnings to grow at least double the nominal rate of GDP growth. And this is consistent with that. In fact, it's right on that number, right? So we had, I think, approximately 3.2% nominal GDP growth. So the nominal number is not inflation adjusted, and neither is the S&P earnings number, by the way, that I'm citing here. 6.4 is exactly double that. So those are good numbers. But at 3 times price to sales, I think that's close to an all-time high, if it's not an all-time high. And in fact, we can take a look at that, and why don't we? And so, having just plugged this in and not tried it yet, let's see what happens if I press that button. Aha! So we have my Bloomberg terminal. Good. So we can actually take a look at this. So let's just take a quick peek. Pleased to see this. We're just going to take a look at price to sales, price to forward, earnings, and we will look back as far as we can. So just for those of you who aren't familiar with the Bloomberg terminal, so I guess they're not both at all-time highs, but they're not far off of it. This goes back to 1990. Some of this data I know I can, if I was just using trailing numbers, I'd actually be able to go further back in time than this. But I think this is a suitable, 35 years-ish or more. Let's see how far back we're going. What is that first quarter? Is that the first quarter of 1990? Second quarter of 1990? Yeah, so this data begins with the second quarter of 1990. So just as you look at this number here in blue, this number represents the price to sales at about 3 times. We can see that it was briefly higher than that during the pandemic. So we had that big rally, and there's a lot of enthusiasm for equities, but we've subsequently seen, of course, that was in anticipation of an economic recovery, largely fueled by some aggressive policy measures as well as pent-up demand. We got that, so that's the reason it's not at all-time highs, but not far off of them. And at least according to this, the S&P is trading around 22.6 times forward earnings estimates. And when I share my screen, just so for those of you who are going to be watching this, that's what this number is. So this is BEST, Bloomberg estimates. So that's basically taking the estimated earnings over the current price to get to that number. We can take a look at where this is in terms of the context of history here. That's what we're going to do. So we can see that actually back in December of 1999, it was higher than it is now at about 29.6. So we're looking at maybe seven turns richer than it is at the moment. That's probably not much consolation, given what happened beginning in March of 2000. We should also remember that was a time, the tech bubble, some valuations were truly mind-bending, because in many cases we were dealing with companies that actually did not have any profits at all. So when you don't have any profits at all, your price to earnings can approach infinity. So that probably has a lot to do with that. Okay, so let's try to go back here and let me see if I've got anybody here whose questions I may be able to answer. Okay, so PC says, hi, Mike. Bullish on Goldman Sachs. Let's see here. I just want to make sure I have this. Bullish on Goldman Sachs. August 460-500 call spread, question mark. So plan to replace them in 3 weeks with November options. What do you think? All right, well, let's just take a quick peek here. And I'm just going to go over to, what we can do, this may be useful for you all, is that I can actually do this same analysis for Goldman. I'll just use the same screen. And I guess if I use the same screen, that's going to be helpful for context. By the way, we won't have as much history for Goldman Sachs in terms of its fundamental data, and that is because the company went public in the late 1990s. I remember that very well. The reason I remember that so well was because I was actually one of the first market makers in the Goldman Sachs options pit on the American Stock Exchange at the time. I think there was probably about 10 of us when it first listed. There was usually a much bigger delay than there is these days, by the way, between when the underlying equity listed and they became eligible for options. But in any case, traded Goldman options since they were very first listed, made markets and those things from the very beginning. Also happened to clear our options trading business at Goldman Sachs. As it happened, we had a JBO with Spear Leads, which later became GSEC. So it's part of their clearing operation. Anyway, let's take a look. Okay, so historically, the multiple doesn't seem unattractive. It's actually below average. So that's a start. By the way, one thing I do like, so we're about to kick off a new earnings season, and we would prefer, of course, to, generally speaking, be long optionality going into known catalysts, as I often like to say. And if options prices are very expensive, implying a move much larger than it would normally provide, then maybe a spread makes sense. But generally speaking, being long optionality is a trade I like. Let's take a look at what the options market is implying and compare that to its history. Implied move 3.25%, at least according to this, which is only about 1% higher than, that's a very low average move. That's interesting. So you had back in 2023, we had this one-day decline of about 6.5%, 7% one-day decline back when they reported their Q4 21 earnings. But yeah, no, I do like that strategy. Let's take a quick look at this in options play. If I can bring that up, we can take a look at the strategy that you're talking about and then go from there. So we are looking at the August 46500. Kill that. I should have had this queued up. I apologize, but like I said, I just drove into my brother's driveway, which is where I am, by the way, at my brother's house. Moments before we began. So there was a bit of a mad dash to get this going. So you said August. I'm assuming you mean the August regulars. And yeah, so this is what we're looking at right here. At least as of the close. I don't know where you put this thing on, but $15 on a $40 spread, just under 40% probability of profit, but you've chosen a direction. So that's an important point also when using the probability of profit. I sometimes feel is by itself used a bit too much as the mechanism by which one scores an options trade. If you have a very high probability of profit, that's good. And if the probability of profit is less than 50-50, then that's not. I don't adhere to that. A couple of reasons for it, and I can provide a really simple example. You could sell an out-of-the-money call option on Goldman Sachs for, let's say, a penny that has virtually no chance of ending up in the money. Does that make it a good trade? Well, no, of course not. First of all, it's probably going to eat up all of the premium you collect just by the commissions and expenses that you pay. It is a balancing act that you are trying to find between the probability of profit and the risk that you're taking. And in this case, you're taking $15 worth of risk, 3% of the current stock price on $460 stock, actually a little bit less. So to me, I don't think that's a huge amount of risk. You've chosen a direction, and I say it's a little bit less risk than that because actually this call spread is almost $3.60 in the money. So what you're really paying away is going to be the extrinsic premium, which is the total amount of premium that's in the trade less how much it's already in the money, the $3.60. So we're talking about $11.30-ish of extrinsic premium. And so that's basically the decay that you're paying, and you have a known catalyst. And I think it's a reasonable trade. I also don't think it's a bad idea to push it out to November if you were thinking about doing that. Let's just double check it. I mean, first of all, that will almost certainly capture the subsequent earnings, which are actually forecast for October 15th. So that's an estimate, by the way. But either or. One other thing you might consider is spreading that out in part, so you could actually remain short the upside call leg. Actually, how much? Let's take a quick peek. How much premium is in that thing? Oh, more than 1%. Okay, so more than 1% of the current stock price 46 days ago. Yeah, I mean, I generally like to get at least 1% of the underlying. It's not as easy to adjust for leverage in the case of financials because all financials are heavily levered. So I've previously discussed how you can sort of account for how much leverage there is on a balance sheet by comparing enterprise value to market capitalization for a company. Not really so easy to do for a bank. Banks just are heavily levered. It's the nature of the beast. So I'd probably like to see at least 12% annualized. Yeah, so you could push out the 460, maybe roll up to what, the 470s for November. That would be a possibility, and then take in those 500s or shorten them up. Just try to get close to 1%. I'd probably lean towards something like that. You'd increase your probability of profit somewhat. Like I said, that's not the only metric, so don't try to structure all of your trades just around that, because it's really more about risk reward. Okay, so let's move on to another question. Ranjana Gupta, welcome back. A while ago, I bought an August 2nd par 100 strike October 87.5 poor man's covered call on Nike for 970. Nike is now around 75. What should I do? Yeah, that was quite the disaster, Nike earnings, weren't they? So I wrote about this and I spoke about it. And I was inclined actually on the bullish side, which is what I think we discussed before they reported. But one of the things I did highlight was that they were losing market share. Now, again, you can go back to that video. So I'm just going to go by memory because I don't have any notes in front of me. But if memory serves, at least according to Yipit data, Nike's market share in January was something like 39%, and it had declined to 32% market share at Dick's Sporting Goods, according to that data, as of May. Areas where they were losing market share was to Hoka, which is a Deckers brand, and to Owen Holdings, Owen shoe brand. You really need to see them get back to some measure of growth to justify the multiple that maybe even now that they're trading at. But let's remember this: before earnings, they were trading around 23 times forward earnings. And also remember, as we just talked about at the beginning of this, the S&P is growing 6 to 7% earnings year on year. So if you want to have a multiple higher than the S&P, which is 23 times forward earnings, coincidentally, right? So S&P is 23 times forward. Nike was 23 times then estimated forward earnings prior to earnings, and then you deliver no growth. Well, clearly that's not great, because you could simply buy the S&P. You have a more diversified and more consistent trajectory of both revenue and earnings growth there. So I'm not 100% sure that all of the damage isn't done, which, by the way, though, is the reason why, they call it a poor man's covered call, but really it's a bit of a hedged covered call, isn't it? Because the idea is that you are risking less, you're committing less capital than you would have done had you bought the stock. And in addition to that, committing less capital, just the fact is your absolute risk is less, because you have that long dated option. If the stock really collapsed, your risk is going to be limited to the premium spent. That said, I really think Nike's got a tough row to hoe, it seems to me. So what should I do? Well, let's just take a quick peek. First of all, let's load up the trade that you have here. So, and actually, a lot of people were probably in this position. I commented about the fact that there was well above average options volume on Fast Money right before they reported, 2 days before they reported. And I think the usual cast of characters, friends of mine, I should say, were colleagues whom I respect, were all on the desk. And it was pretty much universal, actually, that folks felt, it's trading 5-6 turns cheaper than it has done. You have the Olympics coming up. I made the point that I wasn't sure the Olympics are necessarily something to get excited about, because as the father of 2 teenagers who like Nike products, they're not buying Nike shoes because of what people are sporting during the Olympics. It's probably what basketball player is wearing them. There's, some real trendiness on all of that front. So anyway, technically also this thing is it's a disaster. which is another problem. But let's just take a look at the strategy. So the October 87.5, we'll just get long those here. And those are going to be pretty low delta, I imagine, by now. Those are calls. And you are short the August 2nd. Well, the August 2nd, I mean, that one's clear, right? I mean, you can let it go or cover these things for nothing because these options are now worthless. So you collected all the premium that you could have collected. Yeah, look at this. You can buy those things back for 2 cents. And I usually do that. I mean, just to clean up the sheets, really. So that's probably the first thing I would do. Something else that you can do is just continue to write against it, so you can go out a little bit or maybe down and out. But let's just take a look. If you turn this in, is there any premium to turning this into a straight calendar? Not really. Believe it or not, something else you could consider is actually turning it into a sort of a form of a credit spread by selling a lower strike call than the one that you own. And I like call credit spreads as a strategy, like iron condors, between catalysts. And now we are between catalysts because the news is out. And that actually brings up another point, which is what catalyst is going to propel the stock meaningfully higher here? Well, one thing that could, in some stocks cases, would be, we had Spirit Aerosystems got acquired by Boeing. They announced it yesterday. I think everybody saw that coming anyway. But you could obviously have something like that, where another player steps in and makes an investment or decides that they're going to buy the company. That's really not a factor in Nike. So I actually wouldn't even mind, selling some lower strike calls against it, and just rolling a call credit spread up until we get the next earnings. Once again, I'm looking to collect 1% or thereabouts over every month or so, 12% annualized. Something to think about. So, Ranjana, I don't know if that helps you, but it's a very different strategy than the one that you entered into initially, which, by the way, I liked. In fact, even discussed that strategy. I don't know whether it was exactly those strikes, but that was the idea. But, it's a different stock. We have to recognize one of the reasons that stocks move on earnings is because you're presented with new information. We have new information. So what do you do with that information? You can either decide that you're going to take your punishment, take your medicine, or you can say, well, looking at this, it seems that they have some continued problems. I don't expect them to work their way out of the woods. I already have that call on, and I'm willing to sell call credit spreads, or in this case, diagonals, against it, looking to capture the accelerated decay that you're likely to get out of that shorter dated option. So something to think about. And I don't think you're alone in this because, this was something that I was doing. So, I'm just basically sharing my thoughts on Nike off the cuff here. Okay, so let's just take a look here. Please go over delta hedging. Why do you do it? How do you do it? Is it something the average trader can and should do? So delta hedging is something that vol traders do. So if I buy volatility rather than buying direction, or selling into a direction. So let me give some examples. Nike, we might as well use Nike since we're just talking about it. Had I been bullish on Nike going into earnings, and actually I expressed the fact that despite their operational challenges, that maybe it was getting cheap enough to take a flyer, but I did not recommend buying the stock because I did indicate that they were losing market share. But the idea is you could get long by buying stock, something I didn't recommend, or by buying call options, or buying call diagonals, or buying call verticals, or potentially by selling puts, cash covered puts, or put credit spreads. But when options traders make markets and options, they're actually trading vol, not direction. And this was something that was beaten into us quite a lot when we first started out, which is they did not want the options traders to start making directional bets on stocks. they really wanted us to focus on volatility. And what that meant was that they did not want us to have any instantaneous exposure to the movement of the underlying stock, which means we had to be delta neutral. So if I bought 130 delta calls, that would mean that I had to sell 3,000 shares of stock and thus remain delta neutral. And assuming I didn't do any other options trades as the stock rises, because if gamma, the delta would increase, then I would have to trade more stock. Also, if the stock did not move, but as time passes, the delta decreases. And so then I would have to blow out some of the stock position. The idea being that at any given time, the traders were not supposed to be taking punts on the direction of the stock. Now, remember also that options market makers, guys that trade vol, often are trading many, many stocks, 10, 20, maybe 40 stocks, believe it or not, could be in your portfolio. And actually, when I was doing it as a block market maker, my portfolio probably had about 150 stocks in it, because you're making markets and securities that your institutional clients are trading. And I'm not in a position to predict that. They're going to come in and they say they want to buy some calls or buy some puts or whatever it is that they want to do. And they're looking for us to commit some capital and make a price on those. And that's not to say that I wouldn't have a directional view and wouldn't establish it after the fact. But right off the bat, if somebody's making a directional bet and you don't really know what they're betting on and you haven't had enough time to do your own work, then you want to be delta neutral. So volatility traders are typically delta neutral, unless there's firm-wide conviction. Can individual traders do it? Of course, but you're going to be trading vol then, not direction. So just an important point about that. And then you obviously care a great deal about whether you're getting volatility at a good price or not. And what do I mean by that? Let's just take a quick peek, and we'll take a look at Nike again. So I've shown this chart before where I'm comparing the realized volatility, how much the stock is actually moving around, to how much the options market is implying that the stock is going to move around. And just for consistency, I'm going to take a look at 1 month vol, and I'm going to look at 20 or 22-day realized volatility. The logic there being that the way this happens to work is it's calculated based on actual trading days. So what we can see here is that we had this big move in implied volatility up before earnings, and of course that's come way down. And interestingly, what we can see is that move in implied volatility, big as it was not big enough, because we can see that the stock, and actually I can just include the stock price on this chart, actually moved far more sharply than the options market anticipated. So as high as those prices were, not a bad idea to have actually been long vol. Look, we don't have a crystal ball. We don't know what's going to happen. But the objective here is to try to buy options when they are implying moves less than we might anticipate. Now, of course, if you have some edge on your directional thesis, that can help make up for some of that. But that's the reason, if that helps, why one trades delta neutral. Now, you also don't have to trade delta neutral. I should add that point. So if you happen to have a $500,000 portfolio and you buy one of the SPX contracts that I was talking about, like the August monthly 5350 puts for $50, 5,000 because there's a 100 multiplier, 1% a year. So you're hedging your $500,000 portfolio. Are you hedging it perfectly? Well, instantaneously, no. As I pointed out, it's a 30 delta. So you essentially are taking your long delta position, a delta 1 position, 100 delta, and you're reducing it to 70, and then adjusting for the gamma, of course, of the option. But delta hedging can be used to mitigate the amount of exposure you have if an options position's immediate exposure becomes too great. Here's another case where you can use it. Let's say that you owned call options going into Nike options a week ago. And let's further say that the news came out, and after hours, the stock traded up 15% instead of trading down 15% the way it did. And as you're looking at the results, as you listen to management on the call, you're thinking to yourself, I think this is overdone. I really don't think the stock should be up 15% here. What do you do about your long call option? Well, the thing is, you can't trade out of the calls because calls don't trade 24/7. Options market is closed. You could hedge by selling some stock after hours. If you own 10 calls, the stock's up 15%. They were 40 delta calls, now they're 80. And you could say, you know what, I'm willing to carry the same 40 deltas that I had before. Well, you could sell 40 deltas worth of stock and true it up that way. So that's another instance where delta hedging can make sense, even if you're not trading volatility per se, because options aren't open or aren't accessible. Options markets aren't accessible as stock can be after hours. So that's another time when I think it can be very helpful. Have done that as well. Let's see. Okay. Oops. I click on these things. I apologize for that. You see me doing what I click on these comments because I normally have this social media interaction, and that brings it up on screen. But what it does here is it basically obscures my view of the question, which is, so I've got to stop clicking on these things because I'm making it only harder for myself. Hi, Mike. What do you think of USO today or this week? It breaks above 80 and could stay above 80. Is a bullish sign. The news on oil is very volatile. Do you suggest we hold off till API? Well, first of all, with respect to the API data, you can go to the EIA website regularly and try to map these trends and see what's going on. It's interesting because, of course, and this isn't the only thing, and you said WII, like the Sony Wii, I think is what it looks like there, but I assume what you mean is WTI, West Texas Intermediate. So that's the US crude. That's actually what I traded on NYMEX. Actually, Brent has sort of overtaken it, arguably, in some quarters as the benchmark. West Texas always used to be the benchmark. And what's interesting is that West Texas Intermediate, especially in an election year and with politicians who are willing to pander a little bit, normally I would say that they could step up and cap it. But the fact of the matter is that the Strategic Petroleum Reserve is currently at all-time lows. So there is no ability really for the Biden administration to suppress oil prices much further than they have done by selling out what they have. And I really think that was imprudent, but it is what it is. It does seem like demand is pretty good, but I would actually just follow the trend. And I don't know that I would necessarily hold off until you get the API data, because that's going to create a step change shift. So if you were bullish, then you could get long now. A quick point about that, though. So USO, for those who don't know, is the U.S. oil fund. UNG is the U.S. natural gas fund. And these are exchange-traded products, ETFs, that permit people who would like to speculate on those commodities but do not trade futures to do so. It's a fine trading vehicle. I'm not objecting to that at all. But I would point out these are not investment vehicles. It seems convenient because they trade like a stock, so you can buy USO and you can say, oh, well, I'll just buy $50,000 worth of USO, and I'll just always have some oil in my portfolio. The problem with that is that what the U.S. natural gas fund does and what the U.S. oil fund does is that portfolio essentially goes out and it buys the futures. And then as those futures come close to expiration, then they roll. And they have to roll all the time. Now, Originally, both of those just traded exchange-listed futures contracts. So for the U.S. Natural Gas Fund, for example, that meant that they traded the Henry Hub natural gas contract on the NYMEX. The problem with that is that there are exchange rules with respect to position limits. They bumped into them a number of years ago. Some of you who have watched this channel before know that I was actually involved in that trade, and UNG became hard to borrow. So now actually it's not as straightforward. They trade swaps. But the short version, without getting too into it, and if you want to learn more, then I recommend you read their prospectus and get more details. But the short version of all of this is that because there is a portfolio that is constantly being managed and positions that are constantly being adjusted, there is a roll cost. And that roll cost is particularly acute when the term structure of the futures is in contango. So what does that mean? Contango just basically means that the long-dated futures, which is the normal case in many commodity situations, that the long-dated futures trade at a premium to the near-dated ones. And that as you slide towards spot, the value of the future essentially converges to spot. And so you can imagine that if I had $100,000 and I own some futures, and those futures converge to spot, so decline very slightly. It's not going to be huge, but they're going to converge to spot, so they decline slightly. And then I have to roll out. I'm going to pay more for the subsequent future in a contango market. So the same amount of money is going to buy me fewer futures. And that's a form of decay. So, and this makes sense because there is a cost to purchasing the underlying commodity as well. You say, well, if you just went out and bought one contract's worth of oil, 1,000 barrels, what are you going to do with that? Well, it has to be stored, it has to be insured, that kind of thing. So there is a cost to storage, and the futures will reflect that. So there is a cost to money, it's going to reflect that. There is a cost to storage, it's going to reflect that. Even gold, which obviously the quality of gold doesn't degrade over time. A lot of money can be stored in relatively small amount of the underlying commodity, but still you have to account for the cost of money. You still have to account for the cost of storage and insurance, and so the futures will typically be in contango. That results in this roll cost, which means that it decays over time. And so I like these products as trading vehicles only, not as long-term holds. I think that actually, you can buy maybe a broad commodity fund that's based on, say, the Bloomberg Commodity Index. If you want to generally have exposure to commodities, that would be a way to do it. If you want to own some physical gold and you have it, presumably you came about it legitimately, unlike Senator Menendez, couldn't resist, sorry, keeping it in your sock drawer or whatever he was doing. That's also fine. But just be aware of it when you're trading these exchange-traded products. Okay, so let's see here. Also trying to do a diagonal put spread on SPY. Any suggestion? Just heading. Okay, so the interesting thing about the diagonal put spread on SPY, which is not a terrible idea when you have this increase in skew, because you're going to sell the near dated option. The near dated option, lately that implied volatility, that premium is slightly elevated, so that's a plus. You are helping to finance the longer term insurance. The problem, though, is, let's just say, for the sake of argument, that the reason you're putting this hedge on has to do with the exact topic that I was discussing at the top of this stream, which was the Democratic National Convention, for example. Who's going to run? Is Biden going to continue to seek re-election, or is Kamala Harris going to take his place? Is Gavin Newsom, Governor Whitmer? I mean, there's a number of people who would probably love to have it. All of them are saying and doing all the right things as far as the Democrats are concerned, to say, no, we support Biden, or they had been. But the problem with the diagonal is that while you own that longer dated put option, you are short gamma, you're short convexity in the near term. So if you wanted to do that, at this time, I think that's a little a little risky because if something's going to happen, it's going to happen within the next 60 days. I mean, if he makes it to the long end of the DNC, I think we can assume that he's going to be the candidate on the ballot as far as the Democrats are concerned in November. And actually, by the way, it's my understanding that now on the ballot, even if he was replaced, he would remain actually on some ballots in some states just because of the way the state law works, even through the election, which is a complication all its own. So that might be part of the angst that the Democrats right now are dealing with. What is the matter on CVS that could be? So what is the matter with CVS? Well, did anybody see Walgreens boots? I mean, these things are, it's just a disaster. So it's interesting to me. Let's just talk about Walgreens boots first. Hardly could see something that looks uglier than this. Now, those who have been listening to management will know that the company was going to close, I think, 200 underperforming stores. But the CEO mentioned that at least, and they have over 8,000, that something like 10% of these stores are underperforming. And then he also made a comment that said that in some cities, I live outside San Francisco, so I'll talk about that. If you have a situation where you're permitting shoplifting, essentially, these stores cannot be profitable. Those losses, it just doesn't work. And of course, some politicians in the Bay Area have proposed that they make it illegal for you to close your store without at least a year's notice. Well, that could technically work for larger chain operators like Walgreens, small businesses. You file for bankruptcy, you could do whatever and just say, the party's over, we're not going to continue. But it is a problem for these guys. They are facing competition from other businesses that are competing in their space. There's many, look, if Amazon's getting into your business, watch out, right? I think we've pretty much figured that out because they are willing to go in at very low margins. If Walmart's willing to go into your business, they can go in at very low margins. They operate their businesses very effectively. They have excellent supply chain management, and this is a significant problem. And this thing is trading. It's trading really like they don't have much of a future. I'm sorry to say, and. CVS, actually, I'm sorry, I shouldn't do it this way. Let's do it. Let's do it this way so we can take a look at the performance of these things together. So this is the staples, but let me just put CVS in here. And now we're going to get a chance to take a look at how these things are doing over the course of the last 5 years relative to the market generally. And, in the case of CVS, by the way, we can see that it is significantly outperforming Walgreens. But at least since the beginning of 2022, they're exhibiting very similar patterns. So it is absolutely a problem. Okay. So I'm sorry. Somebody just pointed out, I'm talking, but I'm not showing. And I should show but not talk. So there we are. Let's just go back. I'm going to go actually to the beginning of 2022 and have a look. And you can see what's happening here. CVS better than Walgreens, but it ain't great. I don't think that there's any positive spin we can really put on this. And I think I've also mentioned repeatedly on this stream that, I would like to see the top line for a business growing at least as fast or faster than the economy. And I want to see the bottom line growing at least as fast or faster than I'm getting out of the S&P, or else I have to get it at a huge discount, because otherwise I don't know why you don't just buy SPY. So it has to be something very compelling. It doesn't have to be NVIDIA, but it's got to be compelling. It's either got to be ludicrously cheap. We're talking about 10 times earnings, something like that, for me to start contemplating looking at things that are not exhibiting meaningful growth. Okay, I'm just going to maybe I'm going to just double check here because I just realized I have chewed up in my bleary, unshaven state an hour of your time on this pre-Independence Day Monday. For those of you who tuned in, I really appreciate it. I would like to thank you. If you like this kind of content, or if you want to know when I'm going to be doing one of these again, subscribe, although I do try to do these regularly on Mondays and Wednesdays at 4:15 Eastern Time. Wednesday is a partial day. Do we have a half day? Or I'm not exactly sure. My intention right now is to do Wednesday's live stream ahead of Independence Day. And I hope to see you all then. So thank you all very much for watching.